This week on the Mornings with Joel CRE podcast, I'm joined by Shams Merchant, partner at MW Law. We'll discuss what it really takes to raise capital for commercial real estate, how syndications are structured, and the legal strategies behind successful investment deals. If you're an investor, developer, entrepreneur, or simply interested in commercial real estate, this is a conversation you won't want to miss. Join us live this Wednesday. Bring your questions, and we'll answer as many as we can in real time. This week on the Mornings with Joel CRE podcast, I'm joined by Shams Merchant, partner at MW Law. We'll discuss what it really takes to raise capital for commercial real estate, how syndications are structured, and the legal strategies behind successful investment deals. If you're an investor, developer, entrepreneur, or simply interested in commercial real estate, this is a conversation you won't want to miss. Join us live this Wednesday. Bring your questions, and we'll answer as many as we can in real time. This week,
Step into the future with EcoCrypt, a platform unifying decentralized finance with real-world utility, where value flows freely. From gaming achievements to real-world assets, everything can be tokenized, fractional, and accessible in one trusted ecosystem. For gamers, investors, and global communities, EcoCrypt is breaking down barriers and democratizing finance. Join the revolution. Visit ecocryptusa.com today.
This week on the Mornings with Joel CRE podcast, I'm joined by Shams Merchant, partner at MW Law. We'll discuss what it really takes to raise capital for commercial real estate, how syndications are structured, and the legal strategies behind successful investment deals. If you're an investor, developer, entrepreneur, or simply interested in commercial real estate, this is a conversation you won't want to miss. Join us live this Wednesday. Bring your questions, and we'll answer as many as we can in real time.
All right. Hello, everyone. Thank you for joining the Mornings with Joel CRE podcast. As always, we're very, very excited to have you with us. We have a special guest today, Shams Merchant, and he will be going over what he does in his law firm as it relates to commercial real estate and all the activity that he has going on there. So he's based in Dallas, but Shams, how you doing today, man? Good to have you.
Yeah, man. Thanks so much for having me, Joel. Big fan of the show, and I'm really glad to be on.
Well, thank you. Thank you. Glad you've been watching from the distance. So now that you're on, we're happy to have you. So thank you for being here. So Shams, as I mentioned offline to you just a minute ago, we call an attorney when we need stuff done. They do the legal paperwork and then they go on and play golf, right?
Yeah.
It looks
I
like
love
you
golf,
do a little
so
bit more than
that makes sense.
Okay, all right. But you get a little bit more involved. It seems like you've been doing a lot, but give us a little bit about your background. I know you're a lawyer by profession. What's your background? How did you get to where you are today?
Yeah, no, it's a great question, man. Yeah, I am a lawyer by profession, but like you mentioned, I'm also an active real estate investor as well. Very,
Okay.
very involved with investing. I kind of got here the way most lawyers do. Decided, want to go to law school, be in real estate. Goal is always to be a commercial real estate attorney. That's kind of changed over time because I've started, investing more and doing other things aside from being an attorney. And then, when I started practicing, I was more of what we call like a pure dirt lawyer, right? Like I was
Mm,
doing transactions, helping people buy and sell, large commercial assets, right?
okay.
That role has shifted over time to being more of a private equity attorney, which is
Okay.
more so structuring the investment vehicles, syndications, funds,
Hmm.
joint ventures. It's still helping with the acquisition, but more so now I focus more on the capital stack side of things, right? Is helping my clients, be SEC compliant, raise capital legally, things like that, versus doing more pure acquisition work. Still do a lot of that too, but my role has just shifted more to more so of the how do I scale and raise capital and grow a business. So that's kind of where I am today.
Gotcha. How many years you been practicing now and in this space, would you say?
Yeah, it's been about 6 years, so
Okay.
not too long, but also I think a decent amount of time,
Mhm.
to gain a lot of experience. And I've just been lucky, man. I worked for some great lawyers early on that taught me a
Mhm.
lot of good things, taught me, good habits. Just leverage that to get better and better over time. Um, and that's kind of how I got to where I am and to being able to service my own clients and having a book of business and being someone that's trusted to handle large deals. So
Yeah, yeah. Well, it's interesting because, as you mentioned, you're kind of on both sides of the table. So
yeah,
you know the legal side, and then you also know the real estate side. And
yeah,
that's actually worked well for a few. I know a few other individuals that basically have done the same thing and have done
yeah.
extremely well. I guess because you know how to structure things.
It's a natural fit, right?
Hmm.
When you're seeing your clients do these deals, you're gonna kind of get bit by that bug. You're like,
Right,
hey,
right.
I want to be involved too.
Yep.
So it just I think it's a natural fit. It just happens, and I think a lot of like private equity real estate lawyers,
Hmm.
end up feeling that way and doing that, right? I think it's really common with, or not really common, but more so than people think, with being in this space because you get to see all these great deals being done and you want to be involved in a different level.
Sure, sure. Yeah, no, that makes sense all day long. Absolutely. So,
Yeah.
you've done smaller deals, you've done bigger deals from that standpoint.
Yeah.
What challenges would you say you've had to help clients through as it relates to these bigger deals that come across because $100 million deal is structured different from a $1 million deal, as you know.
Yeah, for sure. It is structured differently when you think about like the capital stack and about the the types of investors that are going to be involved, right? $100 million deal, you're going to have some larger investors, maybe family offices, institutional players, things like that, right?
Right.
Typically, you don't see $100 million deals being done with like retail capital, though very possible, and I have seen it can be done. Just it's
Hmm.
not the typical way to do them. But as far as like the actual deal itself goes, what I tell clients all the time is the difference between a $10 million deal and a $100 million deal is just an extra zero.
Hmm.
That's all it is. The
Hmm.
the deal itself operates the same way. The acquisition process is typically the same. There's some more due diligence involved, but it's really just an extra zero, right? In fact, I think some of the harder deals I've done have been $10 million deals, and the
Yeah.
$100 million deals have been very easy because everyone is so sophisticated.
Hmm.
Everyone is
Hmm.
so like top level that the deal can be ran smoothly. When you're doing smaller deals, the thing is you sometimes are dealing with people that are not as sophisticated, right?
Yeah.
That makes it more challenging. But at
Hmm.
the higher like level of deal making in the space, you'll see that deals are actually very easy to do. They're very smooth.
Yeah.
There's a lot more work to be done, but it's a very smooth process because everyone has knows what they're doing. Um,
Yeah.
so that's kind of what I've experienced over time. I love taking on the $100 million deals because those those are actually, my opinion, than taking on the $10 million deals.
Right, right. Yeah, and they pay better. I will tell
Yeah,
you this, it's kind of interesting you bring that up. One of my buddies, at the time he was running, I think his fund capped out at right at 14 billion. And he was telling me, he was like, Joel, look, man, if you're gonna do a deal, do a big deal. And but it was that reasoning behind it. It was, everybody's sophisticated, everybody knows
yeah.
exactly what's going
Well,
on, so it makes
in the
sense.
effort, I always tell clients to the effort to do $1 million deal and $10 million
Yeah,
deal.
same.
It's the same. Yeah. I mean, if you're going to be putting that much effort into doing a deal, you
Hmm.
might as well do a larger deal,
Right.
right? I think that's where people get stuck sometimes, right? They think
Hmm.
that, hey, I have to start small.
Right.
I have to do maybe $1 million deal, then I can do a $10 million deal. That's not necessarily the case.
Hmm.
If you have a good foundation and you to some level understand what you're doing, have good people in place, good counsel, good people to lean on, right? A good team, right? You've built out a good
Hmm.
team. Then I think even if I see it all the time, right? I see first timers do successful 10,
Hmm.
20, $30 million deals, and do well with them, make money, right? Not screw up. Um, I see people screw up too.
Hmm.
So,
Yeah.
there's both.
Yep.
But that doesn't mean that they screwed up because it was their first deal. They just
Hmm.
didn't do certain things, right? So there's no reason why you can't buy a large property as a first deal. I'm not saying I recommend that either. I'm just saying that if that is the goal, it's a very doable goal if you put in the right team.
Yeah, yeah. And let's talk about that a little bit. That wasn't kind of the direction I was going in, but I think you bring up a very good point. There's a lot of people that they start off in real estate with the single family home thing, right? I'm
Yeah,
going to just
yeah,
I'm gonna flip some homes and then I'm gonna grow to this and grow to that, and then they do a 6 unit multifamily and they kind
yep.
of go from there. Um, and
Great way to start. Great way to start.
yeah,
Like
yeah.
that's
And the
fine.
thing
That's
about
fine.
it is it's
Yeah,
not necessarily bad. You lose a lot of time, You get a lot of bumps and bruises. You're making mistakes on
Yeah.
smaller deals.
Yeah.
But let's talk about that because let's say, someone follows that advice, and I'm not saying it's bad advice. I'm not saying that at all. What I
Yeah.
am saying though is let's look at the challenges that come with that, right? So I'm coming out the gate. I want to do a $50 million deal. Doesn't even have to be a $100 million deal. I put together my team and everything else. What are some of the flags and things that a newbie would need to keep in mind so that he's not diluted down to zero and
Yeah.
basically doing a deal, as one of my compadres says, doing a deal for a ham sandwich, right? They're
Yeah.
really not
Yeah.
not making anything out the deal.
No,
What are
it's a
some
great
things they need to
question.
keep in mind? Yeah.
Yeah, it's a great question. I think the biggest thing to keep in mind there is yeah, how you're structuring it, right?
Mm-hmm.
If that's kind of my role, right? Is structuring it in a way that one, you're being compensated properly to do the deal. You're taking the
Mm-hmm.
right kind of fees, you have the right kind of waterfall set up, when it comes to, how you're going to be getting your promote or your carried interest, right? Which is your kind of essentially your sweat equity,
Yeah, yeah.
a split at the end of the day of the profits, for
Mm-hmm.
doing a deal, right? A successful deal, and then various other fees that I recommend you be taking to
Mm-hmm.
to 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 do that kind of deal, right? In within reason and within what the market is comfortable with. Um, so that's number one, right? Is making sure you have all that in place. Otherwise, you're going to do a deal and you might have a great deal, but you came out not making all the
Mm-hmm.
effort you put in didn't really result in you actually, you know,
Making the money.
getting the financial reward for doing that, right?
Right.
So that's one thing. The second thing is with the $50 million deal, you're gonna need a lot of equity.
Yeah.
You're gonna need a lot of equity.
Mm-hmm.
So you're gonna have to have a really solid capital raising strategy in place,
Mm-hmm.
even before you try to take down that deal. Trying to
Mm-hmm.
raise the equity needed to do a $50 million deal when you have a $50 million deal under contract or something like that, I mean, you're just setting yourself up for failure.
Mm-hmm.
You need to have thought of how we're going to get the capital to do the deal before you're even doing the deal. I think
Yep.
people make that mistake all the time,
Mm-hmm.
right? They find a great deal and then they think about how am I going to raise
Yeah.
capital
Fulfill
for
the
it.
dreams, right? I just got to
Yeah,
get the
not
deal and the money will
yeah,
come. Yeah.
exactly. And it sounds great in theory, but it doesn't
Mm-hmm.
really work when you're practically when you're doing it,
Mm-hmm.
right? I agree with the theory that like money does come if you
Mm-hmm.
when you find great deals, right? It's significantly easier to raise capital for an actual great deal, but
Right.
it's
Then no
still
deal.
yeah, but
Right. Mm-hmm.
practically it's still uh, very difficult when you're under a time crunch to do it, no matter how great the deal is.
Mm-hmm.
Because you don't haven't set up the systems in place. You don't have that lined up. So I think that's the most important thing is thinking about that prior to actually jumping into a $50 million deal is how am I going to actually, get the debt, get the
Right.
equity, right?
Mm-hmm.
And then on the debt part of things, um, you're gonna have to get underwritten by a bank to get a loan to do a deal of that size. Do you
Right.
have the liquidity and the net worth thresholds that the bank's going to be looking for?
Mm-hmm.
If you don't, then you need to partner up with somebody that has that can
Yep.
give you that,
Balance
um,
sheet. Yep.
so balance sheet exactly.
Mm-hmm.
So those are things people don't think about, right, when they're doing a $50 million deal. But I think those are some of the important things to keep in mind.
Right. What have you seen in situations where a person says, "Okay, I'll put up my balance sheet, but it's going to cost you in the GP." So what kind of structure have you
Yeah.
seen in situations like that?
Yeah, we got to be careful about how we structure those things. You can't be adding in GP members into a team just to get their balance sheet when they're not actually doing anything, right? We've seen people do that over the years, and the SEC has come down now
Mm-hmm.
and has made it clear that that's not you're compensating someone to raise capital for you essentially,
Mm-hmm.
and you're putting them in the co-GP for that, right? That's trying to circumvent the rules, right?
Mm-hmm.
So they have to be a legitimate GP co-GP member with you. They have to be
Well,
doing
let's
something
say they
more
are
than
in the
just
deal. Let's
yeah.
say they are. So what structure or situations have you seen in a case like that where, they say, okay, yeah, I'll put on my balance sheet, but I want X because I'm basically, putting up the
Yeah. I
balance
mean,
sheet.
it all comes down to a negotiation, but really it's probably going to be somewhere like a 50-50 type, arrangement, right? Because you really need that person.
Right.
Also, that co-GP is probably going to be the one getting the fees when, for example, when it comes to like taking a fee for like what we call like a loan uh, uh a guarantee fee, right? So when you sign up as a guarantor
Mm-hmm.
on a deal and you have investors, you could take a percentage point or two as a fee for your services of signing off as the guarantor on the loan. Because
Sure.
investors don't sign off as the guarantor, right?
Mhm.
You do as the GP. So you get a couple of points for that. Likely those points are going to have to be given to your co-GP. You're not going to get any of those points because you're leveraging their balance sheet, not
Sure.
your own.
Mhm.
So things like that, again, talk to the right people, talk to the right attorney who knows how
Yeah.
to structure these things, because that's what we're going to be able to do, right? Is figure out exactly what the best way to do it is.
Gotcha, gotcha. Have you seen situations where that balance sheet investor, and I'm just saying that loosely, but I'm talking about them being in the deal, where they'll strip down the promotes and strip down the asset management fees and the acquisition fees and all the rest of it because they're bringing the balance sheet?
Um,
Where you got to
no, not
negotiate around it.
necessarily. Not
Hmm.
necessarily. I think
Okay.
it's more of a split of
Okay.
some kind, and not that they're just going to get all of that just because they're bringing the balance sheet.
Yeah.
I think it's a big service to bring the balance sheet. I think it's a big deal, but it's
Hmm.
also not that as a co-GP member, you're still the one that's not bringing the balance sheet. You're still going to be doing all the heavy lifting of this deal, right? And so you still should get compensated for that accordingly. So,
Okay. Okay.
um, yeah.
Sounds good. Sounds good. Well, we're right at 20 after. So what I want to do is take a quick 20-second break, and we'll be right back here on the Mornings with Joel Siri podcast with Shims Merchant as we go into some other things. You want to stay tuned for this? Sit tight. Thank you for being here with us.
Step into the future with EcoCrypt, a platform unifying decentralized finance with real-world utility, where value flows freely. From gaming achievements to real-world assets, everything can be tokenized, fractional, and accessible in one trusted ecosystem. For gamers, investors, and global communities, EcoCrypt is breaking down barriers and democratizing finance. Join the revolution. Visit ecocryptusa.com today. Step into
Okay. Thank you for
Joel,
staying with us here on the Mornings with Joel Siri podcast. Again, we're here this morning with Shims Merchant, and wanted to talk a little bit about this structure. And from what I understand, you do a lot of fund formation work as well. Um, Talk to me about that because generally, I've been in the market for a long time and I've seen that shift. If you go back to the 80s with Gordon Gecko and those guys, it was fun, 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 right? Even
yep,
through the 90s.
yep,
And then things kind of pivoted to let's just work on getting a good deal and bringing the capital for that deal.
yep.
And now it looks like in certain circles, it's kind of circling back to the fund model. So what are you seeing? Is there an advantage to trying to do a deal per deal structure or a fund model under a 506B or C? Or, I mean, what's your thoughts on all that?
Oh man, I love this question because I get this question every single day from a
Okay.
client. It is probably
Glad to
the
make you happy.
yeah, it is probably the number one question I get, is should I do a fund or should I do
Hmm.
a syndication deal by deal? Oh my God, every day, 5 times a day. Um, and my answer always, the way I start off is always, it depends, right? It depends
Hmm.
on what you want to do. It depends on your business. It depends on your goals. It depends on what you're looking to build. What kind of deals are you looking to do? Both models work very well. It just comes really down to the individual sponsor and what their long-term goals are, right?
Hmm.
Look, I know and have plenty of clients that never have done a fund. They do deal by deal syndications, and they've done more than 70 deals, have $3 billion of AUM. I mean, plenty of clients that I can put in
Hmm.
that bucket, right? They will never do a
Excuse me.
fund
Hmm.
because the model that they're using works. Why mess it up? Right?
Yeah, yeah.
Why try something different when they have figured out where to get the equity from each time? They have investors that love to come in on a deal by deal basis.
Hmm.
They have built out their network. They have built out their process to find deals. They have great deal flow. They're buying 2, 3 deals, every month sometimes. I mean, it's phenomenal,
Yeah.
right? It is a well-oiled machine. Why mess it up with a fund?
Hmm.
The fund does not fit into that business. They don't need it.
Right.
Um, Now I have some operators, right, that only do funds because that is how they set their business up, right? They will go raise a blind pool fund. They will go raise a bunch of money at once. They have access to the capital, right? They know they've built out a deep investor network. They have some good
Hmm.
family offices. They have some good institutional investors. and that trust them on a programmatic basis, and then they will go and use that money to then deploy it over a certain period of time,
Right.
right? That's the blind pool fund model. That works for them.
Hmm.
Again, you can do either. I, I personally, I like the fund model. I like the fund model a lot because I like the idea of being able to raise, especially if you're able to raise the capital. If you could raise the capital, you essentially have this piggy bank of money that you're able
Right.
to tap into when you find great deals. That's why I love the fund model so much because what the fund model lets you do is it lets you replace that job of capital raising when you have a great deal because you've already spent the time to
You've
do
already done
that
it.
and
Yeah.
it's already done. Now
Hmm.
you can focus on just execution, right? That's why I
Right.
like it. It's
But
much
it's a
harder to
big if.
do.
But it's a
It's a
big
big
if.
if because it is
Yeah.
much harder to raise capital that way.
Hmm.
But if you're able to pull it off, it is phenomenal. Again, it's not for everybody, and you need to have a certain things to be able to do it. I always say you need to have a track record, but it's not like it's a necessity, but it's going to help you to raise capital if you have a track record. But this whole hype around, oh, you got to launch a fund, you got to build a fund, we got to calm that down a little bit because
Yeah.
there's plenty of folks out there, plenty of companies that are peddling this thing that you have to launch a fund. That's the way to do deals. That's the way to
Mm.
buy real estate. That's the way to buy private equity. That's the way to do all of this stuff. That's not true.
Yeah.
Um, I don't know why they think peddling that is effective. Maybe because it sounds great to have a fund, right? Everybody wants that, but that's not the best way to do business for sure.
Yeah. Yeah. No, I hear what you're saying. And it's interesting because you're right. The idea of, you got a $1 billion piggy bank, to use your illustration, right?
That
And
is, you sound great.
yeah, yeah, yeah. I mean
You
that's a
sound you,
great
you
that's a
sound like a
great
big deal.
situation, right?
Yeah.
You're able to just look for deals. You're able to execute. What I found though, historically, what I've seen, okay, and again, your experience might be different, is it could take you could die waiting to raise that money to finally close that fund and get to work, right? And
100%.
so you could miss 3, 4, 5 years of deals
Yeah.
because you're trying to raise this fund,
Yeah.
you
Let
know?
me tell you what's even worse than that.
Yeah,
Let's say you did raise the money, but now you have to deploy it. What if the market is not
yeah,
great?
yeah,
You
yeah.
are you are obligated as the fund manager to
Get that
deploy
money out the
capital.
door.
You know what that does? That sometimes forces you to buy bad deals.
Right, right. And then you
So
never,
it's
yeah, and
like
then you get blacklisted going forward. So,
that's what I'm
yeah.
saying. It is not like it's this ideal model that everyone makes it out to be. It's not going to
Mm,
solve all your problems, I'll tell you that. It is
right.
just another model, another way to structure and scale an investment business. That's all it is, but it's not the
Yeah.
only way to do it. And I'm not saying it's the best way. Again, I still prefer that model too, though, but I'm
Mm,
not saying it's the best for everybody, right? The
yeah.
syndication model works just as well, if not better, for a lot of other people.
Right. Why couldn't you do both simultaneously? Why
You
couldn't you
100%
syndicate
can.
deal? Yeah. Okay.
Oh yeah, and
Yeah.
people and clients do it all the time. Yeah,
Hmm.
clients will put together a fund that they can tap into with investors that prefer to invest, on a more of a blind pool basis because they want to get the diversification of a lot of different deals.
Sure. Sure.
And then they'll syndicate those deals as well with a separate offering when they find
Hmm.
a great deal. And then they can kind of combine the two vehicles and tap into each one as they find deals. So
Yeah.
100%. It's much more complicated to do it that way. But
Hmm.
if you've built out a business, yeah, you for sure can do it.
Yeah. Yeah. I think the execution of that works well as well because while you're raising that fund, let's say it takes 5 years, right? You have 5 years of track record now that you can actually add to the model that you're pitching out there to raise that
Correct.
blind pool. So
Correct.
yeah,
Correct.
so
That's the
it,
better
it
way to
works to
do it,
your
Joel.
advantage. Yeah.
That's the better way to do it, Joel. I agree with that, right? This
Yeah.
this whole notion of, hey man, you want to invest in real estate, go build a fund. We
Yeah.
there's people out there saying that, you know who they are. And I'm just like, uh, I don't know, like that's a bad idea. You
Yeah.
know,
Yeah.
that is not the only way to invest in real estate, right? There's so many different ways to do it. You don't have to
Hmm.
launch a fund to do it.
Right. Yeah, exactly. So no, it's a very good point. And that's why I wanted to bring that up because I thought it was interesting, looking at it both different ways and trying to figure out what's best. Because I get the same question too. You hear people saying, well, I'm gonna raise a fund, and I'm like, all right, hope that works out for you. Call me in
Yeah.
5 years. Let me know where you're at.
Look,
So
I got lots of clients that raise funds and doing very well, and we're really good at helping them
yeah.
get to that point, right? I'm aside from just structuring these funds for them, We're a great resource when it comes to capital raising, connecting them with the right people, plugging them in with the right groups, getting equity, getting capital in the door, right? So we know what we're doing in that space as well. And I'll tell you, like, I have a lot of clients that have successfully raised hundreds of millions of dollars, right? It's not like you can't, it's not unheard of. It's a very common thing. I just saw the
Mhm.
news this morning. I forgot what group it was. They just raised $10 billion to do data center infrastructure funds, right?
Mhm.
They raised $10 billion. Those large groups out of New York. Name is slipping me, but it was on my phone this morning on the news. $10 billion. I mean, that's
Yeah, huge money.
massive, right?
Yeah.
The capital is out there, right? And funds are, by Wall Street standards, even when it comes to real estate, funds are still the gold standard of how to do deals, right? Syndications
Mhm.
are actually much newer, I think, than funds, right? Like you said, back in the day, they
Yeah,
were just
yeah.
doing funds.
Right.
Funds was is still the right, it's still the gold standard, right? It's
Hmm.
still the most recognized way to do it. Syndications are a type of fund. They're just a single asset fund, is
Yeah,
all
yeah,
they
yeah.
are,
That's really what they
right?
are.
But
Yeah.
but but because it's still the gold standard, it's still recognizable, and if you know what you're doing, and you take you do a fund with the intention that it is a full-time job to run it and to
Hmm.
raise the capital, then you can be successful, right? And
Right.
very
Right.
successful.
Yeah. Let me ask you about this. How we doing? Yeah, we're good. Um, as it relates to the type of raise, because you have crowdfunding, you have the 506 plans and all of that. What do you recommend for, let's say, a group that's looking to really kind of get going with their syndication model or even their fundraising model, if that's the choice that they decide to go on or go down? What's really the differences between those type of ways of raising capital from a legal standpoint?
Yeah, that's a great question. I break it down into different buckets, right?
Okay.
So you can raise capital, one, from accredited investors, high net worth, retail
Hmm.
capital is what we call it, right?
Yep.
You can raise capital from family offices. You can raise capital from pension funds, sovereign wealth funds,
Yep.
institutional investors, fund to fund managers,
Hmm.
like myself. That's what I do. I'm a fund to fund, and so
Okay.
various ways you can raise capital, right, with different people.
Hmm.
Um, your strategy, right, and your structure will, to some extent, dictate the different pools of capital you will have access to, right? For example, registered investment advisors and broker dealers, they like to deploy capital in large amounts, right? So a fund typically is going to work a little better with those groups because they want to be able to allocate 5 million, 10 million, on a
Yeah.
programmatic basis, right? They
Mhm.
like
And
diversification.
they like,
Um,
yeah,
they're-
I was just about to
yeah,
say that. There's a
yeah.
diversification they like. Yeah.
Yep,
Mhm.
exactly. They're going to be looking for certain things as well. Right, in your documents, they're going to be looking for certain structures, certain fee methods,
Yeah.
all of that. We know how to navigate that world. It's a really
Hmm.
gate-kept world to break into the RIA space. But we know the players, so
Hmm.
we help our clients break into that market. But again, they're looking for very specific things. So the type of structure you build will dictate the capital, right? And so that's why there's a conversation you have with your lawyer, with your securities attorney, way before you're starting to raise capital,
Hmm.
is what we're building and what type of capital we're trying to attract with that structure.
Right.
Retail investors, they're going to look for certain things as well, right? They're going to look for IRR. Retail
Hmm.
investors, they love IRR.
Yeah.
They want to see how kind of IRR they're going to potentially get, right?
Hmm.
Some other players and like institutional investors might not look at that. They might look more so at cash on cash yield, right?
Hmm.
They might look at equity growth over a certain number of years. So everyone's looking for something different, and you
Hmm.
have to build something that is going to attract one or more of those groups, right? And you can do that even in one vehicle by creating different classes of shares and things like that, right? So there's ways to do it to where you can attract different groups of investors. But that's how I would answer that question essentially. Yeah, yeah.
Gotcha. Gotcha. And then what about equity for, well, I guess, yeah. I'm sorry, I kind of answered my own question on that. Well, I was thinking about it from the
Yeah,
standpoint of,
like
there's holes in the market as it relates to capital that's available. Like for an example, we get a lot of calls about people needing pre-dev money,
mhm,
and that's high risk money because you don't know whether it's going to come back. You might do all that due diligence and it's almost like oil speculating. There might be
Yep.
something there, there
Yeah.
might not be something there, right?
Yep.
So you got situations like that. And that's generally the highest risk. And then also land development. You get a lot of
I
folks that want to go out and develop
I
land
love
and
land development.
yeah,
I just raised capital for a land development deal. I love land
really.
development. I'm
Okay.
really bullish on land. Yeah. Well, especially here in North Texas where I'm based. It's we have a boom going out here. And so
Hmm.
I really like that asset class. It's a very underrated asset class is doing
Yeah.
horizontal land development.
Hmm.
So that's something that I'm very bullish on, and I agree, right?
Hmm.
I think Joel, that's a good point, is you should also look for things that other people aren't doing, right? Like for
Right.
example, multifamily, there's a lot of competition, right? And so if you're gonna go try to raise capital for multifamily, you're competing against thousands and thousands of different operators out there that are also trying to
Doing
raise
the
capital
same
to do
thing.
those deals.
Yeah.
Yeah. So it's always good to look for niche asset
Hmm.
classes and products and figure out something that's going to give you more of an edge when you're out in the market to raise capital. If you look like every other player, you're going to have a hard time.
Yeah.
So,
Yeah.
um,
Yeah. And
you
what
know,
happens is you wind up, that money winds up going to the largest funds, because of their brand, and
yeah,
you'll
yeah.
get siphoned out really quick. So,
Yeah, it's going to go to the operators that have built great platforms already over the
hmm,
past decade, right?
yeah.
That have operational leverage, right?
Hmm.
They're vertically integrated and have operational leverage. And that's what it takes in the market these days in multifamily to actually make money, right? You
Yeah.
can't rely on just the asset increasing in valuation like we used to, over
Hmm.
time, right? You need very strong operations. And these groups including a lot of my clients have built out great platforms already, right?
Yeah.
They got huge property management companies, hundreds of employees. How do you compete with that if you
Right.
want to do something similar, right?
Hmm.
You need some edge is what you need.
Yeah. Yeah. It actually, would lean toward a syndication deal, as opposed to just kind of going head to head with groups like that. So, you know,
Yep,
but
exactly.
yeah, yeah. So you gotta evaluate all of that. Let me ask you something also, just in your background, and we'll cover this for a couple of minutes. You've actually got a bunch of ULI distinction awards, and for
Yeah.
y'all who don't know, well, you tell me who's ULI and
Yeah,
what's
ULI
that?
is the Urban Land Institute. It is
Yep.
a very a prestigious institution
Hmm.
in the real estate industry that puts on conferences and puts on produces information and content about the space.
Hmm.
Again, very well-known industry. It's been around for a very, very long time. It's
Hmm.
probably one of the more prestigious groups that we have. I would say it's like a industry group, right? That's how
Sure,
we
yeah, trade organization
categorize it.
for the
Yeah,
most part.
yeah,
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 yeah, yeah,
absolutely.
yeah, yeah.
Yeah.
Yeah, I
So
have a
so the
couple of
distinction awards, yeah, well, I mean, what did you do, guy? I mean,
so
why they
those
say we got to
so
give this guy this award?
in full transparency, those are not my awards. Those are
Okay.
the awards that my clients have received on projects that I've had the pleasure of working on.
Ah, gotcha, gotcha, gotcha.
So because the award itself, yeah, I mean,
Hmm.
it's given to everybody, but it's really
Hmm.
given to the client because it's their project. But
Sure.
we were the counsel attorneys on that project. So those awards are related to most of those projects were in Houston,
Hmm.
where I represented a couple of clients who did a lot of adaptive reuse developments, right? So we would, for example, the number one uh, example I can give you is one of those clients uh, bought a old, abandoned warehouse
Hmm.
district, essentially
Hmm.
converted it into this mixed use development with retail and office and open air spaces and a park and all of this, and won a bunch of awards, including the ULI award. And so that's what we were involved in, right? We helped with the development of that space. We help with the leasing. We help with the debt, all of that, right? We were counsel for that client. And so those are what those awards are related to, is a lot of those types of deals that I did really early on in my career.
Okay.
And so some exciting projects, most of them actually in Houston. A couple of
Okay.
here in Dallas as well, but most in Houston. Yeah.
Okay. All right. Well, no, that's cool. Some really good large scale products. So,
Yep.
Well, that's fantastic. So
Yeah,
let's
if you go in
let's
Houston, you would recognize like where those like you would know what buildings they are. Like
okay.
yeah, it's like they're famous. Like everyone knows what they are. They either visit that shop or
Well, you
that
want to tell
development.
us? You can put it
Yeah,
out
one of
there.
them is
Yeah.
called MKT. That's
Okay.
MKT, developed by Trident Real Estate Partners.
Hmm.
Um, and it is that open air adaptive reuse development that has a bunch of different retail and office tenants there, and it used to
Hmm.
be a warehouse that was fully converted into this award-winning project. And um, it's an excellent project, yeah, and it helped a lot with like the leasing and things like that for that deal. So
Okay.
um, yeah, so a lot of people, it's in the Heights. A lot of people in Houston go visit it. They have a lot of great shops and stuff there. MKT. Yeah.
Okay. Okay. Well, good. Good.
Yeah.
So, all you guys in Houston, now you know. So, actually, I should be in Houston in a few weeks. We're working on a project down there. So, we'll
Well, you
talk
gotta go
about
check
that
out this. You gotta
offline.
go check this place out.
Yeah, yeah, that's the reason I was mentioning it because I definitely would love to go see that. So let's do this. We're at 20 minutes to. We're going to take another quick break for 20 seconds, and when we come back, what I'm going to talk to Shams about, and I think you're going to want to know about this, is if you're getting started, what's his recommendations on that, and if you're trying to scale, what's your recommendation on that? We'll talk about the finish line and what it looks like, when you get there. But then the question becomes, how do you get there and shave that down so that it doesn't take you 30 years to get there? So we'll talk about that a little bit here on the Mornings with Joel CRE podcast. We'll be right back.
The Impact Air 99. We asked real people to try the Impact Air 99.
Breathable, light, but protective.
Feels very comfortable wearing it. It looks cooler.
It's almost surprising how much air you can get in.
Engineered with 6 layers of nanoscreen technology that blocks over 99% of viruses and bacteria while allowing you to breathe freely and speak clearly.
My glasses are not fogging up.
I could wear this all day.
The Impact Air 99. We asked real people to try the Impact Air 99.
Breathable.
All right, thank you for staying with us here on the Mornings with Joel CRE podcast. Happy to have you with you again. Happy to have you with us again, as always. And we're here with Shams Merchant. Sham, what's the name of your law firm again? MW Law out of Dallas?
Yeah, MW Law is where I'm a partner, but I've actually siloed off and started a separate brand
Okay.
and a firm now called Commercial Real Estate Law Group.
Okay.
And that's the firm that I'm running now. We're still heavily affiliated with MW Law, but kind of run my own shop now and more of counsel relationship with that firm.
Okay.
So that's what the firm's called. Yeah, if the website's super easy. It's CRE.law.
Okay. See if I can remember that.
It's super easy. Yeah. Think of commercial real estate, CRE.
Yeah, yeah.
Dot law.
No, I know I'm messing
Yep.
with you, man. Yeah, yeah. So without a doubt, without a doubt. So let's jump into this. As to what I was, mentioning before we went to break. Um, for many people, the finish line is to basically get to the point to where you have the pension funds that are putting money into your deals, right?
Yeah.
That's the CalPERS, CalSTRS, New York. Everybody knows who they are. Teachers,
Yeah.
Texas teachers, so forth and so on.
Yep.
But you don't just get up in the morning and unless you got some heck of a track record, wake up and get money from those groups. I know of
Correct.
individuals, literally it's taken over a decade to be able to tap that well. So for let's say that's the finish line, right? Because they're writing, 9-figure checks to go into your portfolio, and a lot of time they are the underpinning of billion-dollar funds that you see out there. So if a person is getting started, what's the best way you would say for them to get started, if that's where they want to get to, with that being the finish line in their commercial real estate business?
Yeah, great question.
Loaded
I think
question, but yeah.
yeah,
So whatever
I think
direction
the
you
way
want
to
to go
do
with
it,
that.
yeah, no. I think it's a great question, and I think the way to do it is you got to think of being an institutional operator from day one, right?
Mhm.
That means everything that you do has to be of institutional quality from day one, right?
Mhm. And
That
what does
means
that mean? Okay.
it means your documents,
Mhm.
right, are of institutional grade, right?
Mhm.
Your structure is built the way institutions want it to be built.
Mhm.
Your pitch deck, your marketing materials, your marketing collateral, your website, everything about you has to speak to the fact that you are trusted and credible
Mm-hmm.
from day one. That's how you get to that point, right? This is a mistake I see so many people make. They don't think about these things. They just think, oh, I have a great deal, and that's all I need to go and raise a bunch of money and to do and to be successful. I wish that that were the case, but a lot of it comes down to investor trust and credibility, and a lot of that comes down to just optics in general, right? Um, I tell clients all the time this too. Investors are going to judge you based on who's backing you, right? Which law firm are you using and what's their credibility? They're going to look at those things to judge you, right? Because they're looking for ways to make sure that you're trustworthy and credible. And everything you can give them to point them in that direction is going to help you, right? That's what this business comes down to, right? This is still a relationship business at the end of the
Mm-hmm.
day. Um, so that's it, right? It's think institutional quality. Think if you're an investor is looking at you, what are all the things they want to see, right? Um, and do you have all those things, right? And if you don't, then that's why you come to us because we can
Yeah.
help you figure out what that looks like, right? And
Mm-hmm.
help you build accordingly, right? I'm not the guy that's going to build out your pitch deck. That's not what I do.
Mm-hmm.
But I know some really great people that can build out some great pitch decks for you, right?
Mm-hmm.
I know great people that can set you up from a marketing standpoint, um, right? So we have these resources for our clients, because the goal always is to build credibility and trust with the market and with investors. That's what's going to get money in the door.
Mm-hmm.
So
Yeah, no, a very, very good answer. And like you said, that's the thing that's often overlooked is that part of it. Because really, if you got a great deal, and you don't have those pieces of the puzzle in place, it's just going to be difficult for you.
see, when you have those pieces of the puzzle in place, you don't even need great deals sometimes.
Yeah,
You just need deals that you can get to second base with,
right.
right? You don't need a home run,
Yeah.
right? And there's plenty of deals I see all the time, Joel, that are not great deals, but that still get funded, if not overfunded, because those people have built those relationships and have done things the right way. And then
Yeah.
again, I see plenty of great deals that never see the daylight, you
Mm-hmm.
know,
Yeah.
because the rest of the pieces are not there, right? They've they've done everything they could to just cut costs and to be extremely, you know, I don't know what the right word is, but
Mm-hmm.
but I don't want to say cheap, but
Yeah.
like they've cut corners, right?
Mm-hmm.
And when you do that, that's you're not gonna get the result you're looking for,
Yeah.
right? You're
Yeah.
not setting yourself up for success. Even when you have everything in place,
Mm-hmm.
it's still damn hard to get investors. So
Yeah.
imagine not having things in
Imagine,
place.
right? Yeah. So you're
Because
just making it harder on yourself.
even when you do everything right, it's still hard.
Yeah.
So
Yeah.
like, uh, I can't imagine trying to do it when you don't have everything done right. Like
Right. Yeah. You're just wasting time.
you're just wasting time. So
Yeah, yeah. No, that actually is a very, very good answer. And you're right. That's the part that often gets overlooked is what does that package look like from that standpoint? And does it give the credibility and check all the boxes? Because what a lot of people forget also is that if you have somebody working at a fund, they don't want to lose their job either, right?
yeah,
So they don't want to present something that might look a little sketchy because they're thinking about their own neck, possibly getting cut. So.
exactly.
Yeah, yeah.
Exactly.
So
All
they
the
worry
time.
about that. Yeah, without a doubt. So let's say, for an example, you're not that person, but you're the person who, you've done 5 or 6 deals. You've got I don't know, 100 million AUM. Which isn't huge, but you've done some deals. You got a little track record.
You're very
Um,
respectful. Very
yeah, yeah,
respectable.
exactly.
Yeah.
But now you
Yeah,
want to
yeah.
grow to 500 million or $1 billion. What does
Yeah.
that look like? You've already got your deck. So what's that scale strategy that people need to be looking at if they want to scale?
Yeah, that also is a phenomenal question. I think that's $1 million question, or for or $1 billion question, right? If you want
Yeah.
to, if that's what you're trying to get to.
Hmm.
Um, I think again, it comes down to making sure that you've built out the right systems and processes in place when it comes to capital, right? Um, how are you raising capital today, and are you built to scale that raised up to the point where you can get to 500 million or a billion AUM, right? So I think that's something you have to think about, systems and processes, right? I always tell
Hmm.
clients you can't raise capital without systems and processes in place, right?
Right.
Um, So that's the first thing. Second thing is making sure your team is stacked, right? You got great accounting, you have great legal, you have all the things that you need that investors are going to look for, right? Possibly a fund administrator that you like to work with. Um, all of that is set up properly working, right? So that way you're again institutional quality, right? You have all the third party players in place that
Mm-hmm.
are going to support you and back you to do whatever you need.
Sure.
Um, and I think that kind of just it starts there, right? Because if you well, let me add one more thing, and then great deal flow, great
Mm-hmm.
deal flow. You need great deal flow. If you want to scale, you need to be looking at lots of deals every month, hundreds of deals,
Yeah.
right? Um, that's the only way you're gonna be able to buy more, right? And get to the
Mm-hmm.
scale that you want.
Mm-hmm.
Um, also making sure that you're if you're vertically integrated, that you have everything set up. Like if you have a property management company, all that's
Mm-hmm.
structured properly. If you have a development company, that's also built out properly.
Mm-hmm.
All of that's properly disclosed in your documents, things like that. So again, all of those things, right, are is important to scale properly. But I think what it really comes down to is the two most basic and fundamental things is, do you have access to uh, equity and debt,
Mm-hmm.
and the system set up to access those, and then you have great systems and processing in place to get good deal flow. Those two things are
And to vet
at,
those
at,
deals.
at the minimum, you got to have those two. Everything else, then you can get there.
Yeah.
So that's how I look at it.
Got you. Got you. I would add also the ability to vet those deals as well. What does that vetting
Oh,
and underwriting process
100%.
looks like? Yeah.
100% has to be a system, right? You have to be able to
Yeah.
vet out deals because you got to go through 100 to find one or two that are going to be the ones that you can pursue.
Yeah, exactly. And this as well as I do, it's very common for equity investors to take a deal and cut it to shreds, right? From the
Yeah,
standpoint of we think the rents are high here, we think OpEx is below what it should be, and
yeah, yeah,
they'll
yeah.
do all of that to adjust those
Again,
numbers.
comes down how you present the deal as well,
Yeah,
right?
yeah,
How are you presenting it? And making sure you're able to do that effectively, right?
yeah.
Because again, like I said, you don't need a great deal to
Mhm.
get a deal funded. You need good deals, but you don't need great deals. It's
Mhm.
good to have a great deal, but it's not like every deal you're going to get is going to be a home run, right?
Yeah,
And when you're big enough, the good deals are are how you make money,
yeah,
right? Because you have such a big operation, you're going to be buying lots of good deals.
yeah.
When you're starting out, more so, I think Joel, you're right. Like you
Mhm.
need to have a great deal because you need to you need to build that track record and you need to get some home runs in there.
Yeah, exactly. You mentioned something also that I thought was interesting. I made a note about it is being vertically integrated. And it's a hard question to ask because it depends on really the asset class. But let's stick with multifamily just because that's what everybody wants to be in these days. Um, at what point do you think it's important to be vertically integrated? And mainly as regards the property management side of it, as opposed to, because some of the things you already want to have in house, from
Yeah.
that standpoint. So what are your thoughts
Um,
on that?
yeah, I don't know if I'm the best person to answer that question because it's such a business question, but I know
Yeah.
that, my client, I think what my clients would say is once you hit a certain unit count, I think you got to start looking at getting vertically integrated because at that point the economics don't, make sense
Yeah.
for you to then build that platform out.
Hmm.
So I think
Hmm.
it really depends on like where you are, right? And
Yeah.
how many units you currently manage
Hmm.
or are outsourcing the management for. And does it make sense to economically bring those in and take on that? Um, Look, in the long run, vertically integrated is still going to be the best way to do it, but you might not
Hmm.
make sense when you have very few units, right?
Yeah. Yeah.
To build that plot because
Or you'll
it's a
lose
whole separate
money.
business and you
Yeah.
have to build it out. Yeah.
Right.
Usually someone else, and usually it's a team member that you're going to bring on a partner to help you run
Hmm.
that side of the operations because that's a whole different ball game, right?
Yeah.
Managing apartments and buying apartments, it's a completely different thing.
Totally
So
different. Yeah, yeah. I I've kind of seen over time where it's it's phased, and what I mean by that is if historically the number has been if you have roughly over 100 to 150 units, you can have on-site
yeah,
people there, right, in order to manage the asset and you're not losing money. Then
yeah,
if you go to, beyond that, let's say, well, I don't want to put any numbers on it, but you get to a certain other size where it's you will lose money if you were completely vertically integrated and you need to outsource that. But then at a
Correct.
certain point of units, you do need to insort, bring that inside so that you are vertically integrated.
Correct.
And so it's yeah, it's just the progression of your business
It
over time and the
Yeah,
phasing of it.
it, it's the same thing when you're considering like also adding on like maybe a construction arm or something like
Yeah.
that. So know a lot of clients that have that, and
Hmm.
that's even more vertically integrated. And hats off to them,
Yeah.
because I think that's what a lot of investors are looking for these days. Because look, when you have a construction arm in place, you can control costs better too
Hmm.
when you're doing value add plays, right?
Right.
Cost and timelines. That's very important.
Hmm.
But the to set that up, you need to have enough deal flow to where it makes sense to be able to do that,
Yeah.
right? So you need to be renovating enough units to where it makes sense to have an in-house construction company.
Hmm. Hmm.
Otherwise, it doesn't make sense, right?
Right.
So
Right. Yeah.
um, so
Or you
those are the
hire a bunch of people
considerations.
and then you lay them off 6 months later, which
That's what I'm
that
saying.
doesn't make
Yeah,
sense. Yeah. Yeah.
yeah.
Absolutely. So. Yeah, well, this has been a great conversation. We could actually sit here for another 3 hours just kind of talking scenarios and everything else going on. But as we close out, what would you want our audience to know? You know what? I didn't mention this also, and I apologize. If there's any questions out there, actually, I think there's two in the chat. No, that's actually something internal. If there's any questions that you guys wanted to ask, try to get those in the chat now. Apologize for not bringing that up earlier, and we'll try to get those addressed. But Shams, what in the meantime do you think people need to keep in mind? What would you like our audience to know as we go away today? What should they keep in mind?
Oh man, I mean, there's so much. We talked about so many different things. Honestly, all of it. I mean, I think what to keep in mind is not to follow the hype that you're seeing with doing certain things, right? Like whether it be launching a fund or even doing a syndication or anything like that. Like don't follow the hype. I think you need to talk to people, understand the business you're trying to build, and then figure out the right model to do that, and not
Mhm.
just follow blindly behind what you're seeing, a bunch of people pitch in the market, right? Because people are going to peddle whatever they can. It's up to you to figure out what makes sense for your personal goals in business. Because there's no right or wrong way to do it. It just depends on, what you're looking to do in particular. So I think that that's the most important thing. Talk to the right advisors and people to understand what your options are, and not just blindly follow some model because, that's what you're seeing online.
Gotcha, gotcha. And I do have one last question for you. What's your ideal client?
Yeah, I mean, my ideal client is look, I service, people that are doing their first fund or syndication all the way to clients that have done, tens of billions of dollars, right? And continue to do that. So my ideal client can be anybody on that spectrum, right? It could be someone who is interested in just in doing a syndication or a fund and wants the proper guidance, the proper
Mhm.
structure, and the resources to go do it. Or it could be a multi-billion dollar operator that is looking for better counsel and a better better place to go to handle their work. So anyone, anyone
Okay.
interested
All
in
right.
or actively involved in commercial real estate is a potential client for me. Anyone that's looking to raise capital or raise more capital, raise it better, faster, quicker, and scale, those are clients for me.
Gotcha, gotcha. And you're not state specific, right? Anywhere in the country is okay, or
Anywhere in the country, any
okay.
asset class, any strategy, really. We're asset agnostic. I've done everything from multifamily to student housing to self-storage,
Okay.
retail,
Okay.
office, you name it.
All right. All right. Well, sounds good. Sounds good. So, hey, I really appreciate it. I think we've had a great conversation today. Appreciate you joining here and good to take this deep dive, and have these conversations with somebody who understands the stuff,
I
from
appreciate it, Joel.
both
Thank you
sides
so
of the
much for having
table.
me.
So, yeah,
Yeah.
really, really appreciate that. So, we'll
No,
we'll
thanks so much
definitely
for
keep
having
in
me.
touch. I want to talk to you about some of the stuff we got going on in Houston and a couple of other parts of Texas that I'm not going to
Oh,
mention right now.
I'd love to just
So,
chat. Yeah, and
yeah.
see what we can do. Yeah,
I'll
for
let you know
sure.
what we got going on. So yeah, so appreciate that. But we thank you very much for it, and for all of you here with us today, we welcome you, and oh, we not welcome you. We thank you for being with us here on the Mornings with Joel CRE podcast. Make sure you join us next week. We'll have another very exciting show, and thank you so much for being a regular listener to the show. Have a great afternoon and enjoy yourself. And again, most success to you in your business. Take care. Have a great day.
Are you ready to level up in commercial real estate? Join us on Mornings with Joel CRE podcast, where we bring you exclusive interviews with top deal makers, investors, and industry leaders. Sponsors reach a high-value audience of real estate professionals. Guests share your expertise and grow your influence.